The bond market, or often called the debt market, is actually a market of fixed income that collectively names all the trades and issues of debt securities. Maybe you knew that, maybe you didn't. You obviously clicked on the thumbnail, so you're interested. And this is typically from governments issuing bonds in order to raise capital to pay down debts or fund new projects, create infrastructure improvements, whether that's roads, hospitals, sewage, lighting, electricity, could be solar. They issue bonds for debt to draw money from the public markets. And those bonds are very secured because it's the United States government, and the United States government doesn't default on its debt, right? Or does it? Another video. Investors interested in some of the regular income payments from bonds are more likely to want to look at things from United States Treasury, maybe some international bonds, but these are often very low risk and they allocate capital towards bond funds. Bond funds do allow you to invest across multiple companies and government entities while providing an easy way to liquidate if you need to sell. And we're going to go over maturity dates and bonds a little later on, so make sure you stick around. Bond funds come in many shapes and sizes. Some could be mutual funds, some could be ETFs, or they could be balanced funds. Let me pull up this article here. The bond market here from Titan, and Titan is an investment vehicle I use. I'll link it down in the description below. But the bond market, like I said, is a way to collect debt that the governments use to create money that ends up being debt. And there's really three types. There's the treasury bonds, which are offered by the US government. I said that a minute ago. And those provide protection in inflationary environments. So as inflation goes up, bond prices tend to go up as well. So as inflation moves up, you're getting that kind of one for one there when it comes to the bonds. When inflation comes down at the end of 22, that doesn't mean the inflation period is over. I agree. And one of the investments is kind of cat out of the bag is VTIP that I'm going to talk about. There's the emerging debt market. So that's sold by governments in emerging parts of the world. That could be Brazil, Latin America, India, China. India is a big one. And China is reopening and pivoting away from COVID. Really help drive bond prices there. And then there's municipal bonds. These are sold by cities and states. So that could be maybe the state of California, the state of New York. It doesn't always have to be federal. And each state has their own bonds that they can continue to work through and issue. A lot of these bonds, though, are better suited, I believe, into an ETF. And today we're going to go over some of the top ETF bonds that I have invested in. We're going to go over why. I'm going to judge each one of those. I'm going to show you how you can use those to create quarterly and even monthly dividends. Okay, so the first one is Vanguard BND, the Vanguard Total Bond Market ETF. Why do I like this? I've said this time and time again, and I hope everyone's paying attention. Your expense ratio can kill you if you're not paying attention. Your expense ratio here, 0.03. There's never a 0.00. That wouldn't obviously be managed. There would be nothing there to manage, so you wouldn't have an expense ratio. But 0.03, that's about as low as you can get to have your money managed by Vanguard. In this case, this fund. I do have other funds that I'm going to be going over here shortly that are not Vanguard funds. So if you're not interested in Vanguard, continue to stick around. Extremely low expense ratio. It is a ETF that watches it's an index. Down here, the other thing I like is the inception date. It's going on, 16 years out there. So it's got a great track record. Year-to-date returns 2.80. And I think this is one, like it says here, it provides broad exposure to taxable investment to kind of offset the risk you take from stocks, and even says that down here. You also want to make sure this is a medium or long-term goal. Don't buy this if you're looking to sell in less than 5 years. It can really cause problems. The maturity date, 8.3 years, like I just said a minute ago. That's the maturity on this bond. That's when it will become due. And there are variable and floating interest rates, and then there are set interest rates on this as well. And we'll go over that in just a minute. The yield is a little over 2%, and we went over the expense ratio. If you're looking at performance and fees, you can see BND, here it is, over the last 10 years, or since inception, is 2.92. The year-to-date so far, 2.64. So, you are getting some return. Obviously, you're not beating inflation at 2.94, but you're also not losing money, and you're also very well protected because when I go down here, I can see the portfolio composition. These are mostly treasury. These are not independent or low-grade bonds. And we can also see that 67% comes from the U.S. government. Issuer type, most of these come from the Treasury, United States Treasury, and you can see the maturity date. So almost 70% is between 1 to 5 years and 5 to 10 years. If I click on this, I'll actually be able to see 30% comes from 5 to 10 years. So I said a minute ago, the average maturity date on this one is 8.3 years. So just be aware of that. Distribution, so you can, as you can see, each month they do pay out a dividend. This was 18 cents a share as of 6/6, so a few weeks ago. And as I go back over the last few years, you can see their dividend is continually growing and going up. If I go back a few years, it was 0.13, so 13 cents back in 21, and now it's at 18 cents. You can also see down here the principal and the co-head of fixed income, Joshua Berkman. He's one of the fund managers for this. So this fund will actually give you a lot of exposure, a lot of holdings, a very low expense ratio, and some pretty good returns. And like I talked about earlier, that monthly dividend payment coming in. So down here, when I go down to distributions again, you're getting paid monthly to own this. Okay. The second one, I told you if you don't like Vanguard, this is through BlackRock, so you're able to get some exposure outside of Vanguard. I know Vanguard, BlackRock, the two biggest games in town when it comes to not only ETFs, but bond holdings. So stick with me. I'll make sure we get some more exposure outside of even those as we continue. All right, the second one is AGG. This is the iShares Core U.S. Aggregate Bond ETF. The year-to-date return on this is a little bit higher than what BND was over at Vanguard, although the expense ratio is one click higher. And this does give broad exposure to U.S. grade bonds, and it's a low-cost way to diversify, like I talked about with B&D. I do own a little bit of this in one of my portfolios. I do own this just because, again, I'm about 85 to 90% stocks, then the rest is bonds. And then as I get older, like I've talked about before, I will start to down cycle out of stocks and more into bonds to lower my risk tolerance. As I get older, will become less because I don't have as much time to make up for the losses. You can see here the total return since inception, 3.08%. This fund has been around, I think this was incorporated in 2003. So it's actually been out even longer than BND. You do a monthly dividend just like BND does. One of the things I really like about this is you do have a very long track record, and you do have a lot of net assets in there. So you have 91 billion is actually in there. And that's not million, that's actually $91 billion as of June 21st. So that's a big equity pool there. There's 11,000 different bonds in there, so you've got a lot of exposure. I think for the risk tolerance of this, for the expense ratio, it's a little bit higher than B&D. You are getting a little bit better of a return. You've also got fee structure down here. You've got holdings. Again, much like B&D, most of this is held in the United States Treasuries. Of course, you can see what the rest of them are. Federal National Mortgage Association, bonds backing mortgages, and then your exposure breakdown. Maturity on this one is 8.2 years, so a little bit lower than what the B&D one is. Down here, the aggregate is, 23%. Matures between 7 and 10 years. And again, maturity is nothing more than when the bond comes due. The bond holder has to pay the bond. The people that took out the bond itself, they have to pay back plus any interest. And then again, there are floating and variable mixed bonds. We'll go over that. We'll go over that later. Okay, the third one, VGIT. So we're back to Vanguard. This is the Vanguard Intermediate Term Treasury ETF. The expense ratio here is 0.04, which again, I like that, very low. Risk reward is a 2, so very low again. I like that. Doesn't have the track record that the other two have, but still something you want to look at. These primarily are in U.S. Treasury bonds. So we did earlier talk about, we have housing, we have municipal projects. This ETF is primarily in U.S. Treasury bonds. You are getting, since fund inception, a little bit lower of a return, but you don't have as high of a risk. When I look down here, I can see the bond here and what it's been doing over the last month or so. Yeah. Now, if I go back over the 10-year, like I showed you a minute ago, you'll be able to see, I think it's around 1.9% is what it's made you over the course of the bond. A lot less holdings in this one, so it's not quite as diversified. The duration on this one's 3.2 years, so not quite as long. The yield is 2.45. The expense ratio, again, is a little bit higher. This is 99% U.S. government. So if you are very interested and you're very confident what the U.S. government's doing, again, I would be a little cautious on that to make sure, I'm not saying don't buy this. I'm just saying that between what's going on in Ukraine, what's going on with inflation, I don't know what interest rates are going to do. I think interest rates are probably still going to be sitting around 6 to 7% in another year. If you are a big believer in the U.S. government and you want to put some money in that, you can. You can also see what their holdings are. These are all T-bills. And here's your dividend. So actually, if you go back, they're consistently paying a dividend every single quarter. We started at 6 cents back in 21, and I think that's doubled. Yeah, so they doubled their dividend. So again, the monthly distributions are great. Just be careful on the returns, because over time, these returns are not what you can get with some of the other two. But if you're interested in just U.S. government, continue to look at those. All right, the last one, VGSH. So this is the Vanguard short-term treasury. Like I said, expense ratio is very low. These are all short-term bonds. These provide current income with modest price fluctuation. And these are 1 to 3 years dollar-weighted average maturity. So again, not as long-term as some of the others, but something you definitely want to keep in the portfolio. If I go down here, I can see what it's been doing over the last 10 years. It's got a pretty low difference over the last 52 weeks. We don't have a lot of volatility. And I believe, this only has 96 bonds in it. So again, even smaller than what VGIT is doing. But I think if you're interested in U.S. government bonds, you're still getting a monthly distribution, and you're getting it managed, and you're getting a lower expense ratio. So with that being said, those were 4 bond ETFs that I think have a lot of upside to them. You're getting your monthly distributions, you're getting a lower expense ratio. So to top this all off, what are some benefits of bonds? Investing in bonds does come with some benefits. It's diversification. So bond ETFs provide exposure to a wide range of fixed income securities, reducing risk associated with individual bonds. Kind of like buying an individual stock, you can buy an ETF, increases your diversification, and it drops down your risk. Number 2, liquidity. In exchange traded funds, bond ETFs can be bought and sold throughout the trading day instead of at the end of the day. So that gives you a little bit more flexibility. And then finally, lower costs. So bond ETFs typically have lower expense ratios compared to actively managed bond funds, which can help boost your returns over time. One thing I did want to bring up, as I talked about several times in this video, was maturity on a bond. And maturity on a bond is nothing more than the date in which the principal amount on the bond is repaid to the bondholder. So if I bought a bond for $100,000 and the maturity date is 5 years, at the end of that 5 years, they owe me my $100,000, and I get to collect all the monthly or quarterly or gains on that bond. However, that money is locked up for 5 years or 10 years or 20 years, etc. The maturity date is usually set when the bond is issued and does not change. However, the time to maturity for a bond gets shorter over the bond's life as you move closer to the maturity date. So if you buy a 10-year bond, the maturity date is 10 years from the date of issuance. On the maturity date, the bondholder will receive the full principal amount of the bond, like I just said. So some of the factors that can affect the maturity of a bond, the type of bond, the credit rating of the issuer, and the interest rate environment. So with that being said, bond ETFs can be a valuable addition to your investment portfolio. They can provide passive income, helping you navigate uncertainties, which I think we've all seen plenty of that in 2023. But make sure you do your research, consult with an advisor if you need to, and don't forget to design your financial freedom. Take care. Bye-bye.